Hello, everyone. Welcome to Options Talk, timely option strategies for volatile market conditions. I think the current situation calls for such a webinar because the market is definitely volatile, interesting, to some degree unpredictable, and how options can help us navigate these unpredictable markets. We're going to find out together in this webinar. My name is Daniel, and I will be your moderator throughout this session. I'm greeting you today from our beautiful office here in downtown Montreal in Canada. And before we get started, where are you guys calling in from? Who do we have in the room today? Please put your location into the Q&A box. So who do we have in the room? Please put it into the Q&A. So let me see if we get some locations here. The Q&A box should be enabled. Lenny is there. Hey, Lenny from New York City. Good to have you. Ralph from Winnipeg. Hey, Ralph, how's it going? How's the weather over there? It sounds cold in Winnipeg. It's also cold today in Montreal, -6 degrees. Prasanna from California. Hey there, how's it going? Billy from Houston. Hey, Billy. Nice to have you. Robert from Alexandria in Virginia, I believe. And then we have Robert from Australia, Melbourne. Wow, that's amazing. I've just been to Melbourne. Well, let's say just. When was it? At the end of last year in December, on end of November, I was in Melbourne, a great city. Charles from Virginia Beach, Virginia. Hey, Charles, how's it going? Diane from Chicago. Hey, Diane, good to see you again. Juan from Harlingen, Texas. Hey there. And Ralph is saying in Winnipeg, it's a bit warmer this week. Okay, good for you. Lucky you. All right, guys. Well, thank you so much for sharing your location. Let's get started with this very topical and important webinar. But before we do, a quick reminder that that this session is being recorded and that you can watch the recording shortly afterwards, probably tonight, if not tomorrow morning at this link here, tradingindicators.com/alerts. And I will put this link into the chat box just a bit later. You will also get an email notification when the recording is available. So it's tradingindicators.com/alerts. Also, I do need to remind you that trading does contain risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can't afford to lose. When it comes to backtest performance or hypothetical performance or really anything based on historical price data, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies and setups discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right. So with this out of the way, let me quickly introduce ourselves. For those of you who are perhaps don't know us yet, we are tradingindicators.com. And my name is Daniel. As mentioned before, I'm the guy here on the left-hand side. And as our name suggests, we are specialized on creating innovative trading indicators. We've been doing this for many, many years, for more than 10 years, and we have clients all over the world. And most of what we do is based on technical analysis. This is really our bread and butter. But as of late, we've also put a focus on education, teaching people, educating people on different trading topics, including options trading. And for this purpose, we have teamed up with an expert in options, which is Jim Kenny, the option professor. He's going to come on here in just a bit, introducing himself properly once again, and with his outlook on the market and what option strategy he sees fit in today's market conditions. So we're going to get to this a bit later in this presentation. All right. So, and Billy's saying he got a lot of feedback over the audio. Let me ask everybody else, do you have some kind of echo on your end as well, or is it just Billy, perhaps? Perhaps a quick feedback in the Q&A whether the audio is clear or whether there's an issue with it. Just quickly check here. No, all good there. Okay, Billy, perhaps it's something on your end then. Okay, perfect. All right, let's get started. So what do we have planned for today? These are the talking points, what I want to go through today. And I think talking point number one is perhaps we could say the educational part of this webinar, and the other ones will be more practical, seeing what is tradable right now in the markets. But point number one is imagine you have the perfect technical setup. You see everything very clearly. You have a good idea of where a particular stock may go next. But of course, having a perfect technical setup is just one step, because next you need to decide how you're going to trade the setup. And as you will see, there are many different ways, some better than others. I'm going to talk a little bit about what happens once you have your perfect setup. Then we're going to become or get very practical. We're going to talk about the current market conditions, some key stocks to watch, and some of the challenges that you should consider right now when it comes to trading options. Then we're going to move on. I'm going to, explain to you how you can get free option ideas, a completely free service. And then we also have an exclusive offer to all attendees. And of course, there will be plenty of time for Q&A throughout this session. All right. So let's start with the perfect setup. All right, so for this, I've picked Apple. Of course, everybody knows the Apple stock. It's been a long-term bullish stock. There's some ups and downs, but as you can see, Apple currently is in an uptrend since mid last year. We are bullish on Apple. Prices have gone up very nicely. We made all-time highs in December. Prices came down a bit, then up again, and currently Apple is trading right at this key support level. And people may say, okay, that sounds like a very interesting setup. Prices are no longer extended, like very far from their averages. Prices came down a little bit, coinciding with a key support level. And you may say, okay, this looks like a nice, long, bullish setup to me. So far, so good. Most of you will agree this looks like an interesting setup in the long direction. But of course, question number 2 is, how can we trade this setup? How can we trade this bullish setup? Now, and here the first choice that you may say, okay, what I'm going to do is perhaps I'm going to buy Apple outright. I'm going to buy Apple stock. I want to become an owner of Apple, a part owner of Apple. And you could do this, okay? You can, go ahead and perhaps buy 100 shares of Apple at current market price, which is around $260 a share. So if you do this, your total investment would be 100 times 260 to $26,000. Definitely possible, and perhaps the most straightforward way to trade this bullish setup. Okay, so let's say you've done this. What are we risking when we trade Apple this way, and what can we benefit? And for this, I have generated this little diagram here. Let me make it a bit bigger. There we go. This is what we call a profit loss diagram. It's quite simplistic, but let me explain to you real quick how this one works. So down here at the x-axis, you have the stock price of Apple, like 260, which is the current price, 240, 280, 300, and so forth. That's the stock price. What you see here on the y-axis is your profit or loss. And it's fairly clear, since we're long, if the stock price goes up, let's say from 260 to 280, around here, our profit will be $2,000. Apple went up 20 points. We have 100 shares of Apple. We make $2,000. And conversely, let's say Apple goes down to 240, we stand to lose $2,000. Now we're losing $2,000. And the more stock price goes down, the more we will lose. To the extreme, of course, this is very unlikely to happen, that we could lose all our investment. But of course, the upside is also very interesting when we trade Apple outright. Let's say Apple goes up 60 points from 260 to 320, we stand to gain $6,000 and so forth. That's very linear. As the stock price goes up, we are profiting in a very linear fashion. And if the stock price goes down, we are losing also in a very linear fashion. All right. And for many of out there, this may be a very viable way to trade Apple. But there are also alternatives. As you can imagine, since we are today in an options webinar, one way or one alternative could be, in fact, to use an option strategy. And perhaps one such strategy would be to buy a call option. All right. So let's say this is our strategy. How could we act on this one? Well, to this, I'm going to quickly explain to you the theory behind call options. It's going to be very quick. We have a masterclass recorded on this topic, which goes into all the details, but just a quick overview on the theory. Now, what are options in theory? Well, an option, these are tradable contracts, first of all. An option will give you the right, if you own this contract, give you the right to buy or sell a stock, like Apple, at a certain price for a certain period of time. And these 2 points are important. There's always a strike price involved and an expiration date involved. No matter what you do in options, these are 2 fundamental concepts. So this is what options are in theory. But in practice and in reality, most of the time, options are simply tradable contracts. And as such, you want to buy a contract, let's say if you're going long, at a certain price and sell it later on at a higher price. Okay, these are tradable contracts subject to supply and demand. As the value of a contract goes up and you're long, you will benefit. And if the value of a contract will go down and you are long, you will lose. This is as simple as this. And please keep this in mind. Options really should be treated as tradable contracts. You oftentimes do not wait until expiration. You will get rid of your options contract before that. Now, if you are long options, call or put, these can be great vehicles for speculation. You'll see in a second why, for significant upside potential and for hedging. And if you're long options, what you want to do is you want to buy low and sell high. It's as simple as this. You want the value of your options contract to go up. All right, but there are a couple of things you need to consider. Since every option has an expiration date, owning an options contract, holding an options contract is always a race against time, because all being equal, the value of this options contract will decrease as time passes. That's the fact. And we're going to see in a second, when we simulate a holding options contract over time, what this will do to the value of your options contract. Also, holding option contracts, owning them, being long options contract, is also a bet on increasing implied volatility. All being equal, the value of your contract will go up as implied volatility increases. So it's a bet on implied volatility to increase. All right. Please keep these 2 things in mind, because we're going to get to them later on once we start simulating holding or owning some options. All right, so let's go back to our Apple example. There we go. So we had this great long setup. And what we could do as an example here is we could, for example, buy an options contract with an expiration of April 24, about 2 months out, or maybe 6 weeks out, with a strike price of 260. It's going to be a call contract. So April 24 expiration, it's a call contract with a strike price of 260. Now we want to buy this contract, so we have to pay something for it. We have to pay a premium for this contract. And this premium depends on market forces, on supply and demand. And currently, I just looked this up a couple of minutes ago, the premium, or perhaps an hour ago, is $1,075 to own this options contract. So we have to invest this much money to buy this particular options contract. Now, let me show to you what happens once you own this contract. This is shown here on this slide. So here we have a more fancy version of a profit loss diagram. Let me quickly explain to you how this one works. So down here, once again, on the x-axis, you can see the prices, the stock prices of Apple. Current prices are around 260, I guess around 259, whatever it is. These are the stock prices of Apple. What you also see here is your profit or loss as the strike price decreases or goes up. Okay? All right. And down here, this line will show you what your profit or loss is. And one thing you can see right off the bat, with the fact that you are owning one call option, your loss is limited to what you have paid as the premium. That's absolutely important to understand. You can see here this little red line at the bottom. It doesn't move. It will always stay, when you look here at the y-axis, at 1,075 to the downside. So no matter how deep the price of Apple goes down, to 40, to 100, to $50, your max loss will just be $1,075. This is one of the main benefits of going long options, because you are capping your risk to a certain amount. Okay? All right. Now, let me actually go over to this particular tool, because I want to show you something. All right. So I'm going to go quickly to this tool here. We have it here. It's called OptionsStrat. We're not affiliated with this program, but it's a fantastic program to simulate what will happen to a particular option strategy. In this case, our option strategy is simply to own a call option with a strike price of 260, an expiration of April 24. and we paid a premium of $1,092. And you can see it here. Let me just zoom out a little bit here. Even if Apple goes down to 150, all we can lose is $1,092. That's our risk. And it's always important to first think about your risk and then think about the profit. Okay, let's look at the profit. So what do we see here? All right, so I'm going to go to the right-hand side here. And let's say at expiration on April 24, Apple trades, let's say, at $280. What is our profit? You can see it up here. It's around $890, $916, something around this price. And as Apple or the price goes up of Apple, let's say to $300, this profit will increase. So we basically have infinite profit potential, as the stock price can increase indefinitely with this particular options play and a capped downsize. Sounds really good, doesn't it? But of course, there's also a drawback. What is the drawback? Well, the drawback is before we get into profit, you can see it here, price needs to rise quite a bit. It needs to go up at least, this is our break-even level here, this little blue line. It needs to go to 270.93. You see this one listed below? 2,793 is our break-even point with this particular strategy. All right, so this is when we own a call option. Price needs to go at least to this level until we benefit from this particular strategy. But remember when I said options are tradable contracts and options are rarely held all the way until expiration. So in this case, expiration is April 24. So let's simulate real quick, what would happen if we perhaps sell this options contract earlier? For this, I can use this slider here. I'm going to go down perhaps to, let's say, I don't know, April 1st, April Fool's Day. We're going to sell on that day. Look what happened to our break-even point. Remember, it was at 270 around here. It went down to 266. Why is that? Because remember, options will lose value, option contracts will lose value as time passes. If we wait all the way until expiration, all the time value, all the remaining time value of the option contract has passed. But if you sell this options contract a bit earlier, let's say on April 1st, around the midpoint of the two, until our expiration, the options contract will still have some time value left, and our break-even point is a bit closer by at 266 in this case. Our max loss is still kept at $1,092. This is an important lesson. All right. Now, back to my slides. And I'm going to cut the theory in just a second, but I think this was important to mention. Most options are sold before expiration. Since, regardless, some of the challenges of owning options, of being long options are, you need to, of course, have the right technical setup. If you're wrong directionally, if you're going long, you want to be long Apple, stock price goes down. Also, with this strategy, you will not make any profits. So you need to have the right technical setups. You also want to find symbols where the implied volatility currently at the time when you buy the options contract is rather low and it's expected to rise. And you should be aware of what's called the earnings IV, implied volatility crush. Let me give you another example. All right, let's look at Oracle. All right, so Oracle has earnings coming up next week, March 10th. Earnings are coming up for Oracle. So since earnings are coming up, which is always kind of an unpredictable event, the implied volatility of Apple right now, because earnings are coming right around the corner, is very high. And then once earnings are out, guess what happens to the implied volatility? It's going to go down. Let's have a look how this will affect the options price. I'm going to go back to our tool. Once again, I'm going to pull up Oracle. We're still long. We're using a long strategy. Let's say at current market price at 155, April 24 expiration. Okay, so let's say time passes. The earnings are March 10th. So let's say we are March 11, one day after earnings. And what typically will happen is that the implied volatility, the uncertainty in the market will go down right after earnings. But let's just say it didn't go down. Let's say on March 10th, before the earnings. Okay, what do we see here? We can see, okay, let's say the stock price didn't move at all. We're still at 155. We lost $62 because of time decay. Not too bad, just $62. But then let's go one day later. One day passes, just one day, And because we're after earnings, the implied volatility will go down, let's say, to half. Look what happened here to our options contract once this day has passed. Only one more day has passed, a little time decay, but because of reduction of implied volatility, now our options contract is worth much less, and we are in the negative of $923. This shows you the power and the importance of buying options, going long options when implied volatility is low and ideally expected to rise, because this will increase the value of your options contract. Okay, something important to note. Okay, so let me go back one more time to my slides and back to our example. This was our Apple example, and we want to go long. It's a nice technical setup. Apple's right at key support, expected to rise. What else could we do? Well, instead of buying calls, instead of buying the underlying directly, we could also sell put options. All right, so this is basically shorting an options contract, shorting a put option. Now, once you short options, things kind of reverse. Why is that? Well, first of all, when you short a put option or a call option, doesn't matter what it is, when you short an option, you will receive a premium instead of have to pay one. When you are short an option, you will also bet on time decay. Time decay is in your favor because every day that passes by, this options contract will be worth less. And since you're short, this is good for you. You want this options contract to expire worthless. That's your ideal scenario. And when you are short options, you are betting on the fact that, hey, volatility is decreasing, therefore also decreasing the value of this options contract. All right. So these are the benefits of shorting an option. What we could do, for example, with this particular setup, this bullish setup with Apple, we could sell one put option with a strike price of 260 and an expiration also of April 24. Once we do this, we will receive a premium of $1,027. That sounds really good. Eh? We're receiving money. Everything is now our favor. Time decay is now our favor. A decrease of volatility is now our favor. Fantastic. Where's the downside? Yes, of course, there's a big downside with selling options as well. What do we see here? Once again, back to our profit and loss diagram. What we see here is that our upside potential in this case is capped. Remember, with call options, with owning call options, our downside was capped. When we are selling put options, our upside is capped to what we have received as credit. In this case, $1,027. This is our maximum upside. No matter how much the Apple stock will rise in the future or until expiration, this is our maximum profit potential. What about our maximum loss? Let's go to our simulation tool one more time. So back to Apple. All right. Okay. April 24th expiration. And in this case, let me just remove this. We are selling a put at 260. What do we see here? Well, we see for sure, okay, our upside is kept at $1,027, no matter how expensive Apple stock will be. But what about our downside? Look at this. I've zoomed out a little bit. Let's say Apple goes down to $190 before expiration. We are standing to lose almost $6,000. What if it goes down to 170? Or down by almost $8,000? And you can see with selling options, well, many things are in your favor. Like, your contract will lose value of every passing day because of time decay, but your risk is also uncapped. All right. So back to my slides. Now we're going to go to current market conditions. Now, what are some of these the challenges with selling options? Well, first of all, once again, you need to have the right technical setup. If your technical setup is wrong, nothing will be in your favor. And you want to find symbols where implied volatility currently is high. We will receive a high premium right now, and ideally is expected to go down because this is when you benefit. And of course, one key challenge is that your upside is always capped with potentially unlimited downside risk. All right. Now, this is all to say, trading options, buying or selling, going long or shorting options is more than just predicting where future price will be. Being a successful options trader will come from picking the right expiration, the right strike price, and of course, the right option strategy for the current market conditions. Now, feeling overwhelmed? If this sounds complicated, I feel with you because yes, this can be quite overwhelming because there's so many factors to be considered. This is why we have recorded a masterclass on options trading, 6 hours of options education led by Jim Kenny, the option professor. Normally, it's offered at $397. Today, you can get it completely for free. So please stay tuned for this because this can become a game changer. But we're not there yet because now we want to talk about what is going on right now in the market and which option strategy could work right now in today's market condition. For this, I'm going to bring on Jim, the option professor, on board. Jim, are you there?
Yes, Daniel, can you hear me?
Yes. How are you, my friend?
I'm doing great. We got a lot to talk about tonight, so I'm very excited.
Perfect. Please, Jim, introduce yourself and then,
Yes.
yeah, share the screen.
Share the screen. Okay, guys. I'm Jim, the option professor, graduate of Boston College, and I've been in the options field for decades upon decades and decades. I've done seminars throughout the country and Canada for many decades. So I know how to explain options. I know all about options, and I have my own opinions and my views, which is what I'm going to be sharing with you today. So there will be a lot of what my take is on these things. But of course, we don't give any investment advice. So with that, I'd like to share my screen and
Go
basically
for it.
start trying to help you guys become better option traders, right? So let's get started. Tell me when you're ready.
I'm ready. Are you sharing the screen? Is it
I
shared?
thought so.
Oh, let me just quickly see. Yeah, it's coming up. Perfect, Jim. We can see it. Go ahead.
Okay, great. Hey guys, basically I'm going to go over three things real quick now, and then we'll get into some other stuff. But I'm going to give you a little market overview on a few things. Then I'm going to be going over what setups that I think are quite good. And then I'm going to go over some of the pitfalls that option traders have. So, get a pen and paper if you would, and let's try to get going on this. We're going to start, as you can see, with the S&P 500. Okay, my feeling is that these lows that have been created have got to hold, or else there could be a precipitous drop, and it could be a temporary quick drop. But I think if the ones I show you here would break, it would be problematic. So you can see on the S&P, I do not want it to break this number here, which is 6680. The low's been 6711. I don't think it's coincidental that it went down to that neighborhood and bounced out. So I'm very confident that that's a reasonable support zone, 6681. On the QQQ, the guys that are playing the tech sector, I'm very heavy on 590. 590. You see this low right there? I think if that gets taken out, it could be problematic. It's come down here and tested it a few times. And again, there's a pretty big trap door down here, and there's also a gap there to be filled. So again, if it does start to break, again, it could be problematic. But if it doesn't, you're looking at a very good opportunity as we speak. And then a lot of guys have been jumping into the small caps this year, and they've been a great idea. I was talking about it last year on my alert, saying that the small caps are supposed to outperform the Nasdaq this year, and so far that's exactly what has happened. So as you can see here on the Russell, you definitely want it to stay above purple here, just like it did back in November. So if we start breaking under here, that would be very negative, and there's your trap door down to 230. So when I say there's substantial risk in the market, I mean that if these levels break. Now let's turn towards the VIX. The volatility index, as I've been telling people, must stay under 20 and 18 if we're going to remain in a bull market, and it's not doing that. So obviously that's a risk. Now we just saw it peak out at 28. When did it hit 28? Was it this week? Monday. Okay, so we went up to 28. We have not taken that out since Monday, so that's a good thing. But that trend does look like it's still up, and so there is a risk that we go up. How far would we go? Well, where we might go is to 40. And why do I pick 40? If you take the 60 high over here and the 13 low over here and take a 61% Fibonacci correction, it would take the VIX up to 40. Now, that would be accompanied by some kind of shock, I'm sure, and we certainly have a war going on, so a shock would not be hard to figure. But if that were to occur, and that jumps up to something like 40, I'm going to remember that that's a Fibonacci top possibly. I'm going to remember that there's spots on the S&P that could hold up if we go lower. And where am I getting those spots from? I look to my longer term graphs. And so it could go down into the green line here in that former high, right? So if it really went down sharply and the VIX jumped up and we went down to 6,200, and that would be right, or 6,100, right around this neighborhood, I would think that would be a gift. So the bottom line is the question is will we get a gift, or is it just going to be meandering and then going back up? Only time will tell. One other indicator that I like to keep an eye on that deteriorated a bit but has not broken is the percentage of stocks above their 200-day moving average. Okay, so as you can see here on the 1-year graph, when the market was going in the tank last year in April, look at the percentage of stocks above their 200-day average. Very bad. But what happened after that? Between April and basically November, you had a up and then sideways activity. They tried to break it in November, and they tried to break the stock market at 6,500, but they failed. And the stocks went up to 7,000 on the S&P, and this baby went back up to 65. Now there is a gap down here, and maybe there's going to be a little shakeout again. But if it holds gold, that would be a good sign. Now, if you break gold, then you've got the abyss underneath, and you've got gaps under here. So it could get very, very sloppy. So that's why I'm trying to tell you, this is not a time to go to sleep in the wheel. This is not a time to, just forget about everything. I think it's a good time to focus on things and have some defensive strategies ready in case it starts to break. And then, of course, have some liquidity ready if you get things on sale. Because, again, the economy is fine, right? Everyone's working, 4.3% unemployment. You got deregulation coming. You've got tax refunds coming. You got other stimulus coming. And you've got a lot of things on the upside. The PMIs, the Purchasing Manager Index for both services and manufacturing are in great territory. And the earnings are in the increasing. Don't forget, this is about companies making money. Well, the earnings are up in double digits, and they're expected to continue at that pace. So it's not the darkest environment out there, but in the short run, obviously, it's been a little bit dicey, and we do have an event going on. But don't lose sight of the fact that when I look at things like this, the longer term on the S&P, like the weekly graph, there's still a good uptrend there. And then, of course, on the 20-year, you still got the uptrend. So even if they brought it down and tried to close the gap at 56, 5,800, you got the blue line there. So, don't go crazy if it has a really sharp drop. Keep your powder dry so you can take advantage of it, because this uptrend started, as you can see, back in 08. And that thing, that blue line has been rising ever since. Got violated once here in 2020 because of the COVID. How long did that last? Within a month, it was right back in the game again, right? So keep an eye on the markets, and that's just a quick overview of the stocks there of what I was thinking. And there've been corrections in the foreign markets too. Korea was on fire, and it's had a nice little pullback, but I noticed that it has come down into a neighborhood where it could support. And also Japan was doing quite well. So these are two that buy the dip people might be starting to look at maybe getting in, because rather than 96, you can pick it up at 84. So again, a lot of things have had corrections, but we'll have to see. Now, where are we going to go next, right? That's a good question. Well, why don't we look at a couple? Well, let me show you one thing I've been putting on the alert for a year, and that is about crude oil and the Goldman Sachs Commodity Index. Because if you read the alert, if you read what I'm saying, you must have understood that I said the Goldman Sachs Commodity Index was a huge thing, and crude oil at 55 was a huge thing. And now I'm going to explain what I was seeing. So here you go on the June crude oil. Okay, I went to the 20-year graph, and do you notice I'm looking at these lows, right? And where's my RSI? It has not broken 40. You see, it has not broken 40. Well, it went to 39, but it's, to get this thing to collapse, RSI's got to break 40 and go down into the 20s, and it wasn't doing that. So that made me constructive that it might be bottoming here. But the kicker was the Goldman Sachs Commodity Index, which was indisputably breaking out. Now this is, and boy, it's almost filled the gap. Yeah, it's almost filling the gap. Okay, let me show you what the story is here. Again, I'll go to the 5 year. This is a weekly graph, very clear. Okay, first of all, you can see this was consolidating, but look at the RSI. Down here it was at 38, couldn't break 40, right? Over here, it's already building to 50. Now it's building to 50. Now, once it got above 560, it was breaking out. Now, what's the importance of this thing? Well, half of it is in oil and energy, and the other half is in gold, silver, metals, and agriculture. Well, let's use our common sense thing. If you're going to look at sectors that might be worthwhile to take a shot at, and this thing is breaking out in January, because you can see this is what, January 5th, it's breaking out. And then once it got above gold, there was no stopping it, right? So the bottom line is, now here's the deal. I thought it was going to go fill this gap over here. Can you see that gap? Comes in around 710. Look where the darn thing's at now, 672, up 22 today, right? So the bottom line is, this is no surprise to me that energy is going to fill that gap. And it is done a good job of it. So again, that's why these kind of stocks have been on the alert, right? Since when? Since January. Why? Because it's breaking out along with the Goldman Sachs. That's all you need to do. You don't need 19 sectors. Find one good one. And then the other one was ExxonMobil. And there's many stocks in the oil that have went up and that were on the alerts in the last 6 months, right? And that's one of them. And then Schlumberger. Again, when they make the turn and there's a good reason, it can go. But again, I've noticed now that a lot of the oil stocks haven't been making new highs, even though crude itself has gone up dramatically. And as you can see, crude went all the way up here to 82, right? And so the bottom line is that the oil stocks aren't following it up. So maybe that's telling us that there's a relief. Maybe the VIX inversion, where the spot VIX is higher than the back VIX, is a clue that the VIX is going to calm down. This stuff here, oil, has a backwardation, which means the front month is at 74, but if you look at the deferreds a year out, they're lower. So again, people are thinking this thing going on in the Middle East is temporary. And if they're right, then I'll show you some things where you might want to take a look. Software has barely been beaten up, right? So you look at a company like Oracle, which again, Daniel was referring to. Well, can you see it's come down to my gold line? That's called reversion to the mean. And you can see the RSI down here was 29, and now it's at 37. So there's some divergence down here. Okay, not a bad time to be taking a peek. If you looked at other software like Microsoft, again, has come down pretty far, pretty close to the gold line. What about on the 20-year graph? You see it's right on blue. This is a neighborhood where it could very well have a turn, so you keep an eye on it. Used to be $560, just went down to 380. So that's another one to keep an eye on. And the other ones that already have made a turn, and this is why you have to watch these things. This is how I go about finding these things. Why would I think this CrowdStrike might have been a good thing to take a shot at? Because again, your RSI is at 30, and then it comes down, is at 28, and then it jumps up. But see, on the 1 month graph, you can see divergences starting. And again, when you're looking to do a trade, I always look at the short-term graphs because I'm doing the trade today, right? So I'd like to see some kind of evidence that it could be turning. So when this thing was at 345 and I see 25 on RSI, and then the next door neighbor says 31, and then all of a sudden it's up above 50 and the red line's turning up, and I realize that it's dropped as far as it has. How far has it dropped? It's gone from $580 down to 340. And this is not a business that's going under. These guys are cybersecurity. So this is how we try to find some things each and every week on the alerts. And so again, a couple of the software stocks just today that had divergences. Again, this is how you kind of find these things. This is called Trade Desk, and you can see it's had a nice big up move, right? And if you thought it was nearing a low point, right, you take a look at your 1 month graph and you can see down here you're at 28, and then it immediately goes up and starts getting above what? The red line. And all of a sudden it goes to 45, and now it's above green, red, and blue. Take your shot. And if you took your shot, it's gone from 25 to 33 and you caught a nice pop. Another one that's coming to life that had earnings today, where they said revenues are up 22%, is this guy here, which has also been on the alert. And again, this one is interesting because, as you can see, it came down to the gold line, right? And it's got a gap up here. So if it ever, and now you know what the stock's trading at after market? It's up at 87. So forget about the purple line. It's above the purple line. Now, do you think the options were cheaper now? And again, it had to come down here and try to fool around with this gap. So again, where could it be going? Well, it's at 87 in the aftermarket. If it's going to follow through, it's got potential to fill that gap, in my view. And down here for $100 or $200 was not a very expensive bet to think that it might happen. Again, what I'm specializing in is low-priced options that could possibly explode. And that means sometimes you're going to be wrong, and then sometimes you're going to be right. And when you're right, it obviously has no limit to how far it can go. Also, when I'm looking at things, because I've done this for 30 some odd zillion years, I'm looking to always look at the other side of the trade. Is the seller making a big mistake? If he is, then I'm going to shoot the bullet, right? Because why? Because that's how you make money in options. Somebody's making a mistake. And if you're selling me calls on a stock that used to be at 105 and dropped to 70, and you're selling me calls for $1 or $2, I say you're making a mistake because you're not getting much premium and you're selling into the abyss. And that might work every once in a while, but when it doesn't work, believe me, they'll be paying back big money. So that gives you a little bit. Now, let me show you a couple of other ones here that might have some future on the Mag 7s. And then I'd like to get into the right setup versus, and also the pitfalls. So let's get into a couple of these guys here. I showed you Microsoft. That looks like it could have something going. This is why I thought Amazon might be pretty good. You're testing my number. I'm going to take a shot here. This is where you take your shot, and it's paying off so far. And then the other guy is your Apple. And Apple is, in an uptrend still. So as long as we can stay above 250, and if I look at the 20-year graph, 240, so 240, 250 is an important neighborhood, which if it holds here, and they can finally start figuring out how to monetize the iPhone, which I thought they were going to do yesterday or today, yesterday. These guys have 1.6 billion active users. So if they can figure out something to sell them, they could make a lot of money, right? Okay, so that's there. And then on the crypto, some people think that might be bottoming. I'm not 100% sure of that one, but I am pretty sure that these things are pretty darn sold out. See, this is where MicroStrategy is. So this is the neighborhood, if it can hold, that it might be able to get a turn. And the RSI went to 26, and then the RSI is at 30. And so if it gets going a little bit, looking at the 1 month graph, again, down here, our relative strength is 40, holding it up good. Here, holding 40, pretty good. So there was a reason to take a shot at it when it broke above 130. And again, it just came down to fill the gap. So that would be one, of course. And you know all the names. Hood, right? Is this going to be, is this stopping down here? Or has it got more to go? Trying to make a turn a little bit. What about the other guys that I really like, which is IREN? Again, I'll show you IREN. You see, this is a nice place for it to do something. Now, if it's going to stop, don't you think that's where it would stop? If it's not going to stop, it's going to go into the abyss, right? So this is a place where you focus on it, you monitor it, you check out your strike prices, and you put it on your radar. And the other guy is HUT. Another one, in an uptrend, came back down to hit green. Last time it hit green, it held up. Last time it hit green, it held up. So there's a reason to think that the number of 48 is a kind of an important number. So let's see how that goes, because those are a couple that might do well if the crypto thing can stabilize and turn around. I'm not 100% on it, really, but I definitely see that these things are onto support, and I know that they have done very well in the past because we've been involved in them last year. So they've had a good time of it. So that gives you three sectors there right off the bat and by the way, as I told you with the Goldman Commodity Index, the other stuff that in December were obviously going to be doing well, it was also the gold stocks, right? And look, they had a pretty good move from January all the way up to here. And then, of course, the silver stocks, again, because they're metals, right? And they had a good move from January. Well, they had a darn good move, 85 to 120. So you get the idea. If you get an index like that and you know what's in it, it can give you a tip on that this sector is something you want to take a look at. And, you know, a lot of these grains have been left for dead. But if you know that it's 25% of the index, you might want to think soybeans might go up. And obviously, since January, that's not been a terrible idea either. So that's why in the report, I sometimes talk about general sectors, and that's not a bad thing to have in front of you each and every week. All right, let me quickly go into here, the right setups and stuff like that. So again, I'm going to show you what I view as good setups because again, I'm only buying options that are cheap. So I can't be buying things that have already happened because the options are expensive, right? Right. So when are they cheap? And when do you think it's a pretty good setup, in your opinion, Jim? Well, let me show you. The first one would be divergence. So these are ones that were expiring either January or February. In other words, in the last 2 months, these ideas expired, and I'll show you what we were talking about. Now here on Abercrombie and Fitch, right? Why did I think buying calls in this thing would make any sense? I'll tell you why. First of all, they have a new product coming out for Christmas called Abercrombie Kids, and they were going to market it through Macy's. Then I'm looking at a triple low here, but check out the divergence here. You had the RSI at 19, next door neighbor 38, right? And then over here, you jump up to 43. So then you get all the lines turning up. And so this thing, you know, could really go because if you look at it on a 5-year basis, the darn thing used to be a $200 stock. So when it goes down here, it's time to take a shot. And there's a whole bunch of different charts that gave me an idea that this is, and the options was $200. Now, what do you think it was when it went to 130? More, right? Okay, so that's a setup. It's called divergence and also reversion to the mean. Reversion to the mean can also be a good setup for selling. Let me show you about Dollar General, which was also in the list for the last couple of months expiration. See, when it runs up to the gold line and you have gains at all, you've got a great reason to take your gains because why? It may be difficult to get through the gold line, plus you don't want to risk that kind of a gain, right? So that can also be a destination as well as a support zone. And that's important. Another one that was reversion to the mean was, and this was one just happened here this week. And this is a good example of, you know, how you have to manage the risk too. This is Moderna. Okay. Now Moderna, I thought was very good when it pulled back here. This is called reverting to the mean. And this is where you take your shot. Why do you take your shot? Because it's reverted to the mean and the trend is still up. Okay. Then it got a legal thing go in their favor. And so obviously it popped up here. So I have to figure out what to do, right? Because it popped up here. Okay. Well, I look at the other graphs and I can see there's resistance right here. So do I need a court order to get the heck out? No. I'm running. I'm taking the money and I'm running. If it goes, listen, you're never going to get out at the perfect price. So as long as you accept that, you're going to be a happy person. Right? But you want to have some reasoning behind. So you could use something like I'm doing here, or you could go to something like a 1-month graph, or excuse me, on a 5-day graph. Once you get some kind of a sell, you could do something like that, or you can put it on the real short leash, like as soon as it turned over at 58, as soon as these things, you know, you're looking for an excuse to get out, well, have an excuse with some technical background. Okay. So that's a reversion. That's another reason, you know, a good time to buy. Options are cheap and you got a good reason. Another one would be a turning point. And let me show you a turning point on something like IBM. Okay, on IBM. This is a 1-year graph. So can you see here, when you get a nice big run from 210 up to 300, and then you get a turning point, okay? Then what are you looking for? Well, I'm just talking about what I'm looking for. I'm looking for a potential reversion to the mean. That's door number one, or a big reversion to the mean. That's door number two. And then when it turns up, you hit the calls because that's another time when they're going to be cheap. Now over here, this thing here, I always call this bologna sandwich. And why is it a bologna sandwich? Because when these things break the moving averages, but these moving averages never turn up, they are not long for this world. And that means they're kind of like bologna. And then once it gets back under the averages, you probably have a good shot at a big drop. Now, this guy here, he went through purple, he went through gold, and this was going into the abyss. Now it's having a throwback rally, but this company really got whacked. Now, if you go to the long-term graphs, you can see that there's a reason to take your shot at 220 because you're in the neighborhood of some support. On the 5-year, again, you're in the neighborhood of support. So it wouldn't have been ridiculous to take a shot here. Again, the options would be cheaper here, correct? And obviously the bounce of 30, 40 bucks certainly would not hurt call options. So that gives you a little bit of an idea. Now, let me tell you when a setup wouldn't be interesting to me. Micron Technology, okay? The stock goes up to 460. All of this stuff here, what do you think the call options go for? That doesn't mean they can't be profitable. But I put this on the alert early last year when it was in the 120, 130 range. Do you understand why I put it on the alert at that point? Because I thought it was a good idea. Now it's kind of like silver and gold. You don't really know what to do with those things. Why? Because they've already made a big move and they're bouncing around spastically. And of course, that means you don't really what? You don't know what to do with them. There's no edge. What's your edge? So the bottom line is that, this is when things are not interesting to me. Another example would be Tesla. I mean, now Tesla could be interesting if it's going to hold this level. Now, again, I'm saying this when it's up here, it's of no interest to me. Do you get it? When it has the big pullback, and I put it right on the alert during this time frame when it pulled back here. Again, last year, I thought 250 to 300 was a great time to take a longer term position on it. You can buy options with 6 or 12 months to go if you'd like. And if you're going to do that, you want to do it after a big reversion onto some huge support. You got purple and gold right here. That's a good deal. And obviously you got a heck of a move, but you can't do anything when it's up here. The options are expensive. And even if it goes up, you're probably not going to make money like Daniel was referring to. There's a thing called implied volatility. And to make it a real simple example is, when a stock is down here, it's like a Volkswagen. It's not going to cost very much money because it looks like your car is dead, right? So the options are going to be cheap. That means the implied volatility would be low. Now, when you get up here, you're trying to buy a Ferrari. Now, what do you think they're going to charge for a Ferrari? A lot. So implied volatility means as simple as this. You're going to pay for whatever just happened. And the reason there's a problem with that is the same reason most investors have trouble investing. They think whatever is going on will continue to go on forever. And that's just not the truth. So when you buy things that have already happened on options and they don't happen, like if you buy a call up here at 480, if it goes sideways, you're a loser. If it goes down, you're a loser. And if it goes up, you still could be a loser because you paid such a premium. And as options go in the money, they will only give you the intrinsic at some point, which means the difference between your strike and the current value, if there is any intrinsic. So that's a little bit quick for some of you, but just use your common sense. If you're buying things after the fact, the premium's going to be pretty thick. Again, that's not my business. My business is to buy low-priced options that could explode.
Perfect.
And that's what I'm trying to do.
Jim,
So
yeah, thanks for let's what I would like to do now, because we're getting to the 1 hour mark. We're going to get back to
sure.
the charts in just a bit.
Sure.
But I would like to show everyone how you can get a free trade alert tomorrow. And we also have an exclusive offer prepared for everyone. So I'm going to share my screen again because, Jim has explained some of the ideas that he has in mind. But if you are interested in seeing what he sees when the market opens tomorrow, take into account the market data that comes in tomorrow, we have a freebie for everyone in this room today. And all you need to do is to go to, actually text Jim at this number you can see the number here. I'm going to also put this number into the chat right now. Just give me 1 second. I'm just going to actually paste it in. There we go. And then all what you need to do, and Jim was very gracious to give out his personal cell phone number, so please be careful with that. 1 second. Text Jim. There we go. And all you need to do is say, hey, Jim, this is Daniel, this is John, or Daniela, or whoever. I joined your options webinar. Could you send me an option trade idea tomorrow? Then Jen will text you an idea tomorrow. So his number is here. This is something that Jim is offering to everyone in this room today as a thank you for staying on so long. So please take advantage of this option. Now, this number is in the chat, so there's no rush. You can do it at any time. Just be, mindful that this is his personal number. Okay. Secondly, we have an exclusive offer for all attendees, and let me remind you. Remember when I said in the beginning of this presentation, if all this option stuff sounds very overwhelming and complicated, we have a solution for you. We have an options masterclass recorded for you, which normally starts at $397, and today you can get it for free. Well, this is what we have prepared for you, an exclusive offer for all attendees. Now, but before we get to the free masterclass, what if you could get Jim's option trade ideas served to you on a silver platter? Wouldn't that be cool? Because as you can see, it's not so easy to find the right options trade. You not only need to get your setup right, but you also need to get the moment right when to buy the option, if it even makes sense to buy options right now, because they may be very expensive right now. And you need to get your strategy right, your strike prices right, your expiration right. So it's not so easy. Why not entrust someone who has 30 years plus experience in this space? He trades these strategies on his own account all the time. Well, we have a solution for you, because we have inaugurated an options alert service. We call this options triple play alerts. And the idea is that every Sunday, like clockwork, we will send you a list of interesting symbols, which have interesting setups right now, and where options are affordable right now. We call it the short-term strangle alerts. These have a duration of about 1 or 2 months, so the expiration is about this far out. And all of these alerts have been handpicked by Jim, the option professor, based on his own criteria, which he deems viable to find an interesting options trade. Remember, his credo is, finding low-priced options which have the potential, of course, there are no guarantees, but which have the potential to increase in value by a lot. And the reason why we are focusing on these kind of trades is because many of you have the need to grow a relatively small account into a big account. This is only possible if you're able, to find some of these home run trades where you can able to pick up an options trade at a very low price, which is the potential to increase. This is what we have designed when it comes to our options triple play service. And all you need to do is to go to this link down here, which is tradingindicators.com/alerts, to check it out. Let me put this into the chat as well. So trading, I'm just going to copy and paste it in 1 second before I have a typo in here. Copy, paste. There we go. It's also been posted into the chat. Now, if you are interested, let me give you a sneak preview of what to expect. So first of all, every Sunday, like clockwork, we're sending out our alerts brief, which is basically a newsletter of option ideas, but also with Jim's take on what is going on right now in the markets, with a review of what has happened and what the impact to the market might be. For example, the Iran event, inflation numbers, and so forth. All this is discussed in this service. But of course, most of you are most interested in the option ideas themselves, because I'm short-term strangled. All of these handpicked and laid out for you with an expiration date. Of course, there's the underlying symbol, the strike prices to execute on, and what your approximate cost and risk is. And remember, these are long plays, so your costs are capped at this price here. This is all you could lose with the potential strategy, and the upshot, in theory, at least, is unlimited. All right, so just to give you an idea of what we put out this year on the alerts, and Jim, please chime in on this. Here are some of the highlights, the top movers in 2026, quite a few of them, and the year has just started. So Jim, would you like to comment on some of these ideas that we put out?
Yeah, well, you'll notice that the sectors like Alcoa is in the metal area, and see, that's the key. There's sectors there, so you notice that certain sectors seem to be moving, and obviously those would be the better ones to take a shot at. Now, you got Apple and Amazon in there every week because people like to trade those all the time. So there are some times like we just saw Amazon go from whatever it was up through 217. So that one there has already gone in the money this week. And again, so some of these short-term options can really get a good bounce. But I also have the ones that go out in 1 or 2 months. But the key here is if you look at you look at the different ones, you'll see you have some like Dollar General. Walmart's doing good, Costco's doing good, Dollar General, people are very cost conscious. And so, like I say, the setup was there, but also the sector was good. And then, of course, I had Freeport McMoRan in there with the Alcoa. So copper and aluminum, they're good sectors because the metals are in short supply and big demand. And then, some of the Chinese stocks did quite well early, but now they've come down. But, Alibaba was up there, then went way up, as well as Baidu, and Walmart's in there. And Walmart, went way up, and now it's come back down. But, there's a lot of ideas in there. But I think if you can focus on the sectors or predict the next sector that's going to be going well, that's where you can get some good value out of the different options. But they're always going to be priced in the lower end because, again, the specialty here is to buy options in the 200 neighborhood and then try to get out of them at a substantial. If you get volatility, like Daniel was saying, there's no cap on it. So sometimes things go a lot further than you think. Sometimes they don't go at all. But the bottom line is at least you're going to be alerted. See, that's what I love about this thing. It's an alert. So just because I'm showing you an option, if I alert you to IREN at $8, you can buy the stock as well. And if it goes up to $60, you're not going to be unhappy. And that's what happened last year to all those quantum computers because we did a big seminar in March right at the lows of those things. So everything from Rigetti and D-Wave and everything else, we had people looking at in single digits. So again, when what do you call it? When we had big corrections in things like Micron Technology, it's nice to be alerted that Jim has discovered this is a good time to focus on this stock, and maybe it's a great time to do something with the stock. You can decide, but you might not even have it on your radar, and me putting it in front of you can have a lot of value to you.
Yeah, exactly. And yeah, it's definitely a source of inspiration, but of course, also very actionable because everything in these alerts is laid out for you. Expiration date, underlying strike prices, and what it may cost you, along with the sector this plays in. And of course, as a trader, you also want to diversify. So don't put all your eggs into one sector. Spread it around. Yeah, pick the ones that you like, but at least now you know what has come onto our radar, and then you can pick and choose, like from a menu. Perfect. So we have, in fact, 2 different ways to get involved into our options alert service. And you see one give you even more value than the other one. We have the quarterly option. So the quarterly option typically is cost $3.97 a quarter. It's for 3 months at a time. But today, if you sign up, you will get it for only $2.97. So you get a $100 discount. And now the kicker, this will come with our options masterclass, which by itself costs $397 today. We included completely complimentary. And on top of this, and this is perhaps the most important thing, you get 1 hour of personal coaching with Jim. This is not just by email. This is a phone call with Jim. We can pick his brain, ask him questions, discuss option strategies, or anything you would like to discuss. So this is for the quarterly way. The yearly subscription will give you an even better deal. Not only are we slashing that price down to only $8.97, normally $9.97, not only will you get our 6-hour options masterclass, but you will also get 4 hours of personal coaching. And as a big thank you, and this is really the first time we're doing this, we are offering, if you join us for the yearly option, double the coaching hours, double the private coaching with Jim, the option professor, if you sign up today. In fact, this means you will get 8 hours of coaching. So if you want to take advantage of this, go to tradingindicators.com/alerts and sign up for the yearly option. Only the yearly option will come with this special hour of twice the amount of coaching, 8 hours of coaching. One quick word, if you are already a member of our option alert service, perhaps you have the quarterly subscription right now, you can send us an email. I'll put the email address into the chat in just a bit, that you'd like to upgrade to the yearly option. If you do so, you will also get double the coaching. And of course, the remaining time of your quarterly will be added to the new yearly option. And if you are already on the yearly option and would like to take advantage of the coaching special, you can go for an early renewal of the yearly option. Of course, the remaining time will be added to that as well. So in these two cases, send me a quick note afterwards. Hey, Daniel, I'm interested in this, and I will make this happen to you. And for all of those who want to sign up for the first time, simply go to tradingindicators.com/alerts. All right. So I'm going to paste my email address into the chat in just a second. But I think now, Jim, let's go back to the chart and let's discuss a few more symbols that have become interested. And we're also going to answer some questions as they will come in.
Sure. And I did want to go over pitfalls because I think that could help everyone, because we all have pitfalls when we're trading. And we're going to go over how to work with that. So do you have my chart up there?
1 second. I'm going to stop sharing mine. Yes, we do. Go ahead.
Okay. All right. Well, a couple of different things that I think is common throughout all traders in the options, just like a golfer or anybody who has a technique, you sometimes forget the fundamentals. One of it is sizing your positions. The options that I look for are relatively inexpensive and they have a lot of potential, but they may not work. And if they don't work, you don't want to ding your account very far, because the ones that do work, well, rather than just talk about that, I'm going to show you something, okay? These are ideas that were out that came due, meaning expired in either January or February, which means in the last 8 weeks, these things expired. Now look at the potential on some, not potential, this is exactly how much they jumped. We already know Abercrombie and Fitch, I showed you. That went from $80 to 133, and 275 went to 5,300 bucks. Alibaba, then Cameco, the uranium company, energy, right? 278 all the way up to, it went from 105 to 135, 278 up to $3,000. You've got other ones here. So what's the point? The point is there's a lot of opportunity in this stuff. You heard of DigitalOcean, probably, right? Again, I'm notifying you that these should be looked at right now. You heard of rare metals, rare earth metals, went from 15 to 32, 280 bucks to 1,700. So, I want to be in this game for as far as the eye can see, and that's not going to happen if I do aggressive, lumpy sizing. I'll do 10 here, 5 there, 15 there, 25 there. I don't think that's a great way to go, especially if your account is relatively small. I think, onesies is enough, because again, you want to be in there. And if you ding your account too much and draw down your bankroll, obviously that's going to inhibit you staying in the game. And again, you don't know when Merck is going to be the one that goes up, and I have it hitting 113. Merck hit 130, and you were notified about it at 90. So again, UPS, I think is one gone up to almost like 120 or something like that. So, and then like last year, Teradyne went from 125 up to 190. Shark Ninja, a lot of you guys maybe don't know these companies. Cloudflare, there's Google. Being notified it's time to focus on Google at 225 is not a bad thing to get in your inbox. To tell, somebody that applied material at 210 back in September is not a bad thing to focus on, is not going to hurt you, because that stock has gone through the roof as well. So the bottom line is the alerts can be a very good value to you, but if you size your stuff improperly and You don't use risk management, it's going to be tough. Again, also focus on the sectors that you think have the potential. Earlier this year, again, with the Goldman Sachs index information I was providing, it was clear that the oil, the metals, and the grains, agriculture would be pretty good. And as you can see, you've got energy there that did great, and then you've got these metals that did great, and more metals down there, and more metals down there, and more energy down there. You get it? So the bottom line is the pitfalls are your sizing has to be appropriate for your account size, your sector selection has got to be good, and then your risk management. And again, as far as risk management is concerned, there's three things. Well, let me tell you three
Jim,
things on.
real,
Yeah.
real quick before you get there, because we have some questions actually too.
Okay.
Users asking for the same thing. They said they saw, oh, there are mainly strangles or often strangles only in the report. In fact, we have other traits in there too, but what's mentioned here are strangles. Why not just simply calls or puts?
Well, I tell people that, I'm expressing everything as a strangle because a lot of people like to have insurance on their position in case the whole thing comes down in a big way. Like any insurance, it costs money when the event doesn't occur. So I would suggest that if you think Abercrombie and Fitch has already dropped 80% or whatever, and the likelihood of it going up is like 80% in your mind, and only 10% it might go down, you might just buy the call and then buy the put. This is, these are not, Siamese twins, call and put. They're separate transactions as far as what? You could buy one at one time, you could buy the other at another time. So use your common sense by looking at the graph, looking at the sector, looking at circumstances in the world, and make a determination whether you think this thing could break either way. Now, if you think you can build a case it could go either way, then the strangle makes a lot of sense. If it looks like it's 80, 90% looking like it's going to go up, lock in the call and then buy your raincoat if it starts raining. And that's as simple as that. So all these numbers you see here, 275 might have been $200. $213 might have been $175. Obviously, if you don't buy the puts, all of this risk is reduced because you wouldn't buy the other side, right? So the bottom line is yes. But I mean, like I say, I'm expressing it as a strangle simply because a lot of people like to have both sides covered. Covered meaning they have an opportunity to win on both sides. But that opportunity comes with an expense. And I personally don't like to use that expense all the time. So I make an independent decision whether I want to go in there as a strangle or leg it in. And it's very legal to do legging in. So that would be my input there. And I've said this before to everyone, but yeah. You don't have to go in. These are not the 10 commandments here. These are ideas. You do with them as you like. Use your common sense and your own instinct and your own feelings. But again, I'm alerting you that Abercrombie and Fitch at $80 is something you want to focus on. I'm alerting you that Dollar General is at $120 and you want to take a look at it. I'm alerting you that Chevron's at 160 and now it's at like 200. Whatever. I'm alerting you that Alcoa is at 40 before it goes to 67. So that's the purpose here. You're getting somebody who's done a lot of homework, and then he's giving you the cliff notes, meaning what looks good to him. And you can know that if I found it, it means the options I think are cheap, and I think there could be a big move in the market. So those two things are present if they're on the list, because that's what I'm looking for. And again, for the amount of money we're talking about to get started on this is awful lot of value. I mean, the darn course is $400 right off the bat. And then, of course, the coaching session. Some of you guys don't have that much experience, so it wouldn't kill you. And many subscribers do this. Bring me not only your questions, but come on, let's be honest. You guys are bombarded by 90,000 people telling you this looks good, that looks good. Here's an option here. Here's an option. Bring those ideas to me and let's iron them out. And I can share my opinion based on what I see. And maybe it could either be enhanced by changing the strike or the expiration date. Maybe it's a great idea on the surface, so God bless you. Or maybe it looks terrible and you could avoid a pitfall. So the bottom line is that coaching, I think is extremely valuable because you're talking to a guy, who's got 30 years and more than 30 years experience doing this. And I'm going to give you the best information and the best opinion I can come up with. So there's a lot of value there.
That's a great point, Jim. And William is asking, what about an exit strategy? When do you get out of a strangle? And this is exactly what we cover in the coaching as well in our options masterclass. And of course, there are different ways to get out, and
Yeah.
as mentioned before, oftentimes
Well, I
you
mean,
will
that I was getting into that right now as far as risk management. Again,
go for
there's
it.
three. Again, we talked over sizing, so don't overtrade and don't put 9 million positions on, and be realistic how much money you're working with, and don't, the basic rule: don't risk too much money on any one trade, right? Second thing is sectors. Again, follow the streams where it looks like something's going on. And then that's why I'm starting to look at some software ideas because they're on sale. And I don't think those companies are going out of business. And maybe, just maybe, people overreacted by dumping everything out the window all at once. So anyway, secondly is risk. The other thing is risk management. Now, again, when you have an option, there's a few things you can do with it. You can press it, which means change. I'll show you what this means. You can press it. You can roll it. I'll show you what that means. Or you can abandon it. Right? And why would you abandon it? Because say you have a portfolio of 3 options and one of them's doing great and the other 2 aren't doing so good. Why not keep the one that's doing good, get rid of the other 2, and then look for new plays to add to the one that's looking good? So then you are always moving your trading your portfolio by what? Letting the winners, watering the winners and picking the weeds. So that's one thing to do. But as far as, let me talk about pressing here. Okay. Amazon. This is a perfect example of something I have knowledge with, experience with. Okay. I'm looking at Amazon here and I can see that it's down here on support when it comes down to like 198, right? So let's say, as an example, I bought calls up here when it was at 235, right? And say I bought them that expire in April or May. Well, when this thing comes down here, I'm not sitting there like Buddha, watching Rome burn with Nero. I'm going to be saying, how can I improve my, first of all, do I still believe in this thing? And if I look at my 5-year graph, I say, yes, I do believe in it. So what am I going to do here? I'm going to press my call. What does that mean? Say I have a call option up here at 250 or 245, right? And it starts to drop down here. I'm going to get out of that one, grab some money out of it, add some money, and bring my striking price down towards maybe 200 and maybe shorten my expiration. In other words, I'm out in May, but I can see the lows being made now. So, well, I don't need May anymore. Maybe I'll come into March and say by the end of March, I think it might pop. So you buy a March 200 call rather than holding on to a 240 call out in time. And now if it bounces up to 220, your 200 calls are worth $2,000. And if you paid $300, you just had a darn good trade. And that's called pressing your call down. Now, if it keeps going down, that's called putting good money after bad. But was there a reason why you put it down here? Because you saw on the weekly graph that it was in an area where it could stop, like it was an area that could stop in April. You get the idea now? That's called pressing your call down. Second thing is you can roll the position. Now, I'll give you an example on that one that I had this week. This is Moderna. Okay, I had relatively short-term calls on it, right? And so again, I got into these things on the correction. So when they pop up like this, I didn't know where they're going to have that settlement. That's called, good news, right? So if I have, I'll just look at the option prices so I can show you. So let's say I owned the options that expire on the 27th. And I can see that, say I was in the 44 calls. Okay. And since when I did this, the stock was at 42. So this call might have cost me $2. You get it? The stock just jumped up. You saw that on the graph. So my $2 has jumped up to $10. Now I could sell out that call at $10. And since the market's at 54, I could roll it up to the 59s for $2, 190, right? So if I sell out for 10 and I buy in for 2, I put $8 in my pocket. If I started with $2 or $3, I got my money back plus my profit, and I have a new position at 59. And if this thing goes up to 65, then the 59 call could go to $6, right? 65 minus 59 is $6. So if there's another leg in it, I'd make money. But if it never gets to 59, I'm going to lose 100 or 200 bucks, right? Okay. So that would be rolling it up. What did I elect to do? I elected to take the money and run. Why did I do that? Because now I have extra money to go buy something that's in a better setup where the options are cheap. So I got extra money to work with now. And I noticed that the stock had resistance because I looked at the 5-year graph and I know what the purple line means. And the purple line means reversion to the mean. So did you notice it's already lost $7 off that number? And you know, the options I sold when it was up at 58 and 60 clearly are not the same price. So that's how you manage the risk on that. Again, pressing the call down, rolling the position, or the final thing is abandon it. And you abandon things that you just don't think are happening, you know, and there's plenty of them that weren't happening, you know. Soundhound, clearly, you know, after it broke under 12 has not been happening. SoFi, after it broke under 26 was not happening. That's when you say bye-bye. The calls aren't going to work. Now you had hope. As long as it held the purple, it could have popped this way, right? But hope, just left town,
And that's
right?
also why we put them also out as strangles, because if you think they go up but they don't, then you have to call the put side to cover up for this. So
Yeah, and all those prices, you know, with the strangle, meaning with the insurance put on there or the head, I wouldn't even call it insurance, just the other side of the trade, is still in the $200 range. So no, you're not going that deep into the pocket to have that disaster insurance on it anyway. But yeah, that's a good point. That's an example of where the strangles. I mean, I can show you a bunch of, if anybody, I'm sure people thought IBM was a lovely company. Why did they think that? Well, because the thing went from April 210 all the way up to 330. You think anybody thought it was a great company? Well, it was a really good company. And then one day they figured out that Claude and the coworker could be a problem because they can code without all the expense.
the
And there you
agent,
go.
yeah,
Boom.
cloud agent, I guess
There
it's
you go.
called.
So, that those are the things that happen. And like I say, we're trying to get things in front of you that could be helpful. But those are three things that the pitfalls: sizing, picking the right sector, and then of course risk management, either pressing, rolling, or abandoning positions. Those are some of the pitfalls that really hit everybody.
And John also made a suggestion: if you have a big runner, things are going in your favor, potentially an options collar strategy to supplement it, to secure your wins or to protect your wins. Maybe
Yep.
something to
You can
do as well.
like I say, this is where we can talk about in the coaching sessions. Let me
Yeah.
give you, for instance, on that. Just go back to Moderna again, real quick. You get a winner here, and it's up. And remember, I told you you got the 44 calls. You bought them for 2 in this example, and then basically you're looking at it's at 10. And so if you sold yourself a $55 call, you get $3 or $4. So now you've legged into a $10 spread or $11 spread. Let's say you go $10 spread. So you sell into this 54 number at about $4. So now you're in a spread of 44 and 54, which means you've got the ability to make $10 on that, but your original capital is off the table because you paid 3 and you just took out 4. So what does that mean? That means you got no risk in the trade out of pocket, and you got a free look at a $10 spread if this stock, which is at 53, can be above 54 on March 27th. Like I say, I know a lot about options and I know how to explain them clearly. We're going over stuff at a very brisk pace. On the one-on-one coaching, we pull it in a notch and we go slow until you understand. And then when you understand, then we would go to the next thing. So whether you're just starting out and go, God, what's this all about? Well, first thing is we're going to talk about buying options that are low priced on things we think will move. That's not that complicated. Risk is limited and you think it's going to move. How to trade them after you're in, a little more complicated. That's where the coaching would come in. So listen, I know what's out there, guys. You know what's out there. You don't get to talk to the guy who writes the letter. You don't get to talk to guys who've done it 30 years or more and has traded millions of dollars of the stuff. You don't get to get the guy on the phone. So this is a good deal, and I have no problem tuning my horn on that because it's got a lot of education which lasts a lifetime, and it's got some ideas that could be quite good. That's a good combination.
Yeah, and I'm going to share my screen again, Jim,
Sure.
just to remind everyone of the offer. So I'm going to stop your sharing. Perfect. So yeah, we have this special offer going on right now for the yearly option, and both offers are great, but the yearly one really gives you the most value for your money because not only will you get 4 times the alerts as for the quarterly, not only is it discounted right now at only 897 for the year, not only will you get the options masterclass, which you can watch and rewatch as often as you want, it's on demand, but you will also get not just 4 hours of coaching, but if you sign up, uh, now you will get 8 hours of coaching with Jim, the option professor. And I've got so many questions coming in here in the chat. What could I do when I'm already in a position? How can I protect it? How can I manage my risk? Well, that's a perfect question to bring to Jim's attention. It's super easy to get in touch with him. He already gave out his personal phone number early on today. That's exactly how you approach him. You just text him, "Hey Jim, this is John. I would like to schedule a coaching session with you. Would this or this date work with you?" Jim's going to work it out real quick. It's super easy. And then you talk to Jim and you get all the coaching that you need. And now you get twice the amount of coaching, 8 hours of coaching for the year. And if you renew, of course, you're going to get more coaching with that. So uh, Derek says he likes the sound of this package. All right, yeah, I think that's probably the best offer we've ever given out for the options alert service. And why do we do this? Because we've seen, and Jim, you probably can testify to this, is we've seen that really the besides the alerts, of course, the most valuable thing of the subscription is actually the personal coaching. We all want to become better traders. We all want to make better trading decisions. We all want to find option strategies that are suited to my needs and my risk tolerance. Well, now you have the ability to learn from an expert who's been doing this for 30 plus years. So I think it's a fantastic offer. Tradingindicators.com/alerts. Jim, before you comment on this, a couple of questions that came in. What about exit strategies? So the alerts, yeah, go
Like I
ahead.
say, I was going over exit strategies a little bit there. Again, you have to accept there is no perfect exit strategy. Okay, so once you accept that, you're going to be a happier person. Then you have to come up with a methodology that you are comfortable with. And the methodology can be a number of them. And that's why in the coaching session, we have time to go through the details of each methodology. But if you have no methodology except guessing, luck will run out. So that's why I'm saying I have some methodologies that during the coaching sessions I share. And then again, you guys, can bring stuff to me that you've gotten elsewhere and we
Yeah.
can discuss them. The wheel, this is the big one, the wheel, the wheel. All right. And, they all got pluses and minuses, or else they wouldn't have risk, right? Or the guys over at some of these other firms that like to sell these way out of the money options, or they like to do all kinds of different butterfly. And, let's go through the numbers and really look at what the risk and reward is and what's your objective. If you're taking in option premiums with $50, and you have a small account, it's going to take forever to possibly get your account up. And also, if you're wrong a couple of times on a spread that's got $10 spread, it's going to be very expensive. So again, let's talk, I know the reality and I know the theory of this stuff. So, I think if you have any money in the market of any size, I mean, realistically, $897 over a full year's time is like $70 a month or, $20 a week to talk, to be able to get the options information and talk to a guy if you have a question. I mean, you know what it's like to deal with a lot of these people. You can't get anybody on the phone. They got all those large language models talking to you, right? Well, you can talk to me. I'm not a large language model, but I'm just a
Yeah.
large human being. That's all. No.
Nice. Okay, yeah. Perfect. Let me see if there's some other questions coming in. No, I don't see any questions right now. So just one more thing from my end. of course, if you come on board, you will also be invited to our exclusive lunch and learn sessions, which are taking place every Tuesday at 12 p.m. Eastern time. And Jim will be part, or is always part of these sessions as well. And of course, in these sessions, once you come on board, we will talk options as well, among other things, but a lot of options talk is going on there. We're going to discuss different strategies, some new ideas that came up during the week and midweek and so forth. So this, of course, is also part of you coming on board because you're not just signing up for a service, you will be becoming part of a community of traders and experts like Jim, the option professor. So tradingindicators.com/alerts to take advantage of this unique offer. All right, Jim, I think this brings us pretty much to the end of today's session. We're 1 hour and 30 minutes in. Great attendance, by the way. Almost everyone stayed on until the very end. So thank you guys so much. I know it's late or very early for some of you out there. So thank you guys so much for joining us. The recording will be sent out to you shortly afterwards. If not tonight, you're going to get it tomorrow morning. It depends how fast I can get it out there and rendered. And yeah, hopefully we can welcome you all on board. And if you do, you will get the next option alerts service on Sunday, every Sunday, like clockwork. And of course, our next lunch and learn session, our midweek webinar, will take place on Tuesday at 12 p.m. Eastern time. Of course, these are all recorded. And you will, you'll receive them. And John is wondering, free class? Yeah, that's the complimentary options masterclass, John. So if you come on board to our options alert service, we will give you the complimentary options masterclass.
Well, it's also it's also important, Daniel, that everyone knows that when you hit the word complete purchase, two things happen immediately. Once you're going to get your receipt, and secondly, you're going to get your course. So when you buy tonight, you're going to get the what? You're going to get the receipt, and you're going to have your course ready to go for the weekend. Also, again, the guys who act today will get double the coaching, which is a ridiculous offer, to be honest. But I'm happy to do it because at this point in my life, I enjoy helping people understand this because I can see that there's not many people out there who are really talking that straight about options. And I really like the fact that I'm doing that. So, yeah, again, you're going to get that class immediately. So you'll be studying about options over the weekend. And if you have questions next week, you'll get my cell number, which you already got, and you can text me. You have questions, and if you need a coaching session next week, we can talk about how we can arrange that.
Yeah, exactly. And Juan, if you please send me an email. I put the email into the chat. I'm not exactly sure how to answer your question. Maybe it was a bit abbreviated. Send me a note at info@tradingindicators.com and I'll get back to you. Okay. All right. Perfect. Great, guys. All right. So yeah, this brings us to the end. I hope you enjoyed tonight's session. It's been fun for me. And once again, interesting times in the market. And of course, having the right strategy on your hand is something that you can take advantage of to manage your risk and navigate these volatile markets. With this, guys, thank you so much for joining us. If there was a question which was not answered, please reach out to us directly at tradingindicators.com, which is our homepage. Go to support on our homepage, then to contact, put your question into the contact form, submit it, and it will go straight to my inbox, and I will answer every question personally. So tradingindicators.com is our homepage. Perfect. And Juan, I've taken note of your email, but please resend me your questions because I think they were abbreviated. I wasn't able to understand them fully. Maybe they were out of context a bit. Thank you. Perfect. All right, guys. With this, have a great night or a great morning and talk to you soon. Thanks, Jim. Bye-bye.
Thank you, Daniel.